Spirit Airlines is gone. 34 years in the air, done overnight. Jet fuel has nearly doubled in 2 months. It's not just stranding passengers, this is killing businesses. 19 of the world's 20 largest airlines are cutting flights right now because of the Iran war. 1/3 of Americans have already changed their vacation plans. And while all this is happening, Carnival just digitized fuel procurement across 94 of its ships on a single cloud-native platform. Universal Epic drove 12% up in a single month. Disney is prepping free-roaming AI-powered robots for its parks. The industry is fractioning in real time between the companies built for this moment and the ones that weren't. This is the world where travel meets technology. Welcome back to Cabinets to Clouds. My name is Eric Stoltz, and this is episode 3. If you were with us last week, we talked about the readiness gap, how hotels were dead last in AI adoption, and 5 cruise lines pulling out of the Arabian Gulf. If you're new this week, well then welcome. You picked a great week to start. Because an airline just died, the Iranian war is redrawing economics of travel in real time, and Disney is putting AI-powered robots in its park. So let's get into it. If I had to put a theme on this week, it would be when the ground shifts. The Iranian war and its stranglehold on the Strait of Hormuz, through which about 20% of the world's oil flows, has just sent jet fuel prices to nearly double what they were 2 months ago. That's not a blip, that's a structural shock. And this week we saw exactly what happens when a structural shock hits an industry with a fragile business model underneath it. Spirit Airlines didn't just fail, it collapsed in real time. Overnight, with passengers stranded at airports, air traffic control saying goodbye to the pilots for the last time. But here's what's fascinating about it. And this is why I do what I do for this show. The same week that Spirit fell, Royal Caribbean posted monster earnings. Carnival completed a cloud-native infrastructure overhaul across nearly 100 ships. Disney is unveiling a free-roaming robot built on reinforcement learning. The ground shifted, and we got to see who was standing on solid foundation and who wasn't. So let's start with the good news. Royal Caribbean just posted a first quarter earnings that honestly deserves a standing ovation given the environment. Adjusted EPS of $3.60, up 33% versus the prior year. Strong wave season? I think so. CEO Jason Liberty on the earnings call said, and I'm quoting here, "Disruptive technology and AI have been embedded in our business for years, particularly in the areas that require complex, real-time decision-making at scale." Now, there's a lot to unpack in that quote. We're going to come back to that later in the piece throughout this episode, but the headline is that while airlines are bleeding fuel costs, Royal Caribbean is reporting record-level booking recovery. That's not luck, that's architecture. Their business model is insulated from jet fuel volatility in a way that airlines simply are not. Most cruise guests are already on the ship. Fuel is a cost they absorb at scale, while long-term hedging strategies are in place. Liberty also noted that digital bookings have more than doubled since 2019, and the mobile adoption is over 90%. This ship is becoming a smart platform, not just a vessel. But speaking of fuel costs, Carnival Corporation just made the move that looks to be genius right now, given the week's news. They've deployed Initech's ShipTech platform across all 8 of their cruise lines and all 94 of their ships. This is a cloud-native, end-to-end digital marina fuel procurement platform. Real-time fuel price data, quality, compatibility, availability, all unified across the fleet. Think about that just for a second. In a week where fuel prices have nearly doubled and every aviation company is scrambling, Carnival just gave themselves real-time visibility and procurement intelligence across 94 ships simultaneously. That's the difference between reacting to fuel shock and managing through one. So the VP of Strategic Fuel Sourcing, Michael McNamara, said, Modern cruise operations demand precision at scale. That line is going to be sounding so prophetic by the end of this year. It's crazy. So let's jump into the hotel and hospitality section. The American Customer Satisfaction Index just dropped its Travel Study 2026 based on nearly 15,000 surveys, and the headlines for hotels is actually pretty good. Lodging leads all travel categories with a score of 77, up 1% year over year. Hilton ties Airbnb at 79, Marriott holds strong at 78, IHG fell 4 points to 76, and there's a meaningful drop for Holiday Inns, specifically worth watching, but the more important numbers are buried in the reports. 82% of hotels are actively expanding hotel AI adoption in 2026. Not just experimenting, not piloting, expanding. And 71% of the hospitality professionals are saying that AI is having a significant or transformative impact on their operations. That's a massive shift from where the industry was even 8 months ago. The hotels winning on customer satisfaction scores are the ones deploying AI in revenue management, personalization, and operations, not as a feature, but as infrastructure. So, 1/3 of Americans are changing their vacation plans. What does that actually mean? Well, here's the demand side of the story that hotel operators need to hear. A new ABC News and Washington Post poll found that approximately 1/3 of Americans have already altered their travel or vacation plans because of high fuel costs driven by the Iranian war. 44% are cutting back on driving, and fuel prices have climbed roughly $1.50 per gallon since the conflict began last February. Now, hotel operators, this is a mixed message signal. Few people driving means fewer road trip stops, but it also means that travelers who do go are more deliberate about their choices. And that rewards the properties with the strongest value proposition. If you're running an independent hotel, an RV park, and a glamping operation, understand that travelers are coming to you right now to choose to come to you. Despite real economic pressure, that customer is worth keeping. So the Booking.com travel predictions for 2026 has dropped. Hyper-personalization is now a purchasing behavior. Booking.com surveyed more than 29,000 travelers across 33 countries. And in 2026, their travel prediction report is finding out that travelers aren't just choosing where to go. They're choosing and designing trips that are unique to their identity. 71% say they'd visit a destination inspired by a fantasy setting. Think romantic comedies or romanticities, retreats, castles, stays, destinations that feel like they stepped out of a novel. They're calling this a storyscape travel, and it's real. 65% say that they'd use AI or generative AI to map scenic, off-beaten-track routes amongst Gen Z. The numbers are jumping to 77%, and even 84% are open to carpooling on vacation, with 47% saying they'd use an app to find travel companions headed to the same direction. The demand for personalization has become a purchasing behavior, not a preference. And that means if you're running any kind of hospitality property, the generic experience is a liability. So as we jump into the airlines and aviation segment, this is going to be a pretty deep dive. I mean, we did have an airline completely disappear overnight. And the story hit me a little bit differently because Spirit Airlines wasn't just a business that failed. It was a business model that made flying accessible to millions of Americans who otherwise couldn't afford it. And this week, that model died. Let me walk through exactly what happened and more importantly, why it means so much. let's look at the timeline. Spirit Airlines filed for bankruptcy for the first time in November 2024, then again in August 2025, less than a year later. By April 2026, their bankruptcy lawyer told New York courts that the company's cash isn't going to last very much longer. The final weeks, they were in talks with the Trump administration about a $500 million federal bailout. The deal would have given the government warrants equivalent to 90% equity, but the bondholders couldn't agree on how to restructure, and the deal collapsed. On May 2nd, 2026, yesterday, or 2 days ago, Spirit Airlines began what they called an orderly wind down of operations effective immediately. All flights canceled, customer service shut down, 17,000 jobs gone. The last Spirit flight, NK-1833, Detroit to Dallas-Fort Worth, touched down shortly after midnight. Air traffic controllers said goodbye to the pilots on the radio. And you can find the audio online. It is worth listening to. Now, was the Iranian war what killed Spirit? Yes and no. And this is where I think it gets into the actual mechanics, because this is a technology and a system story just as much as it is a business story. Spirit's restructuring plan, the one they were trying to execute on during their second bankruptcy, assumed jet fuel prices around $224 per gallon in 2026. By late April, jet fuel had surged to $451 per gallon, nearly double in a matter of weeks. This happened because the U.S.-Iranian war the U.S.-Israel war on Iran effectively closed the Strait of Hormuz, the checkpoint through which I said earlier 20% of the oil flows. Brent crude rocketed past $100 a barrel. Jet fuel followed, nearly doubling. According to J.P. Morgan analysts, if these prices held, Spirit's costs would have risen by $360 million by the end of the year. Jet fuel is typically about a quarter of an airline's operating costs. For an ultra-low cost carrier whose entire model depends on razor-thin margins and maximized aircraft utilization, this was not a headwind, this was a wall. But here's the thing, and I want to say this clearly. The Iranian war was the final blow, not the cause. Spirit had been structurally vulnerable for years. Here's why. Ultra-low-cost carrier models worked when it was a differentiator. Spirit pioneered it. Bare-bones service, ultra-low fares, and you paid for everything else with a fee. It was kind of brilliant, and it opened up air travel to people who couldn't afford it before, and it kept the big airlines honest on price. But the big legacy carriers got smart. They created basic economy fares, then they stripped them down to that basic product tier and competed directly with Spirit on price, while offering optional upgrades. Delta, United, American, they all didn't beat Spirit on cost. They beat Spirit on optionality. Travelers could get the Spirit price, but with the Delta network, with the Delta loyalty plan, with the Delta reliability. Spirit's moat evaporated. And when your moat evaporates, your fixed costs are high and your margins are thin, you're one exogenous shock away from total insolvency. And the Iranian war was that shock. So, not to address the elephant in the room, but there was a merger that was blocked in 2024. And it was celebrated by a number of people and said that it was a Biden win for flyers, and said that regulators were right to stand up for consumers and fight against runaway airline consolidations. This week, with Spirit's collapse, the Post is getting a very different read. The argument from the critic is that if the merger went through, Spirit's routes, gates, and operations would have been absorbed into JetBlue instead of just disappearing. 17,000 people would still have their jobs. Millions of low-income travelers would still have affordable flight options. The counter-argument is equally valid. The DOJ argued that the merger would have led to fewer flights and higher fares. That's the trade-off. Regulators made the call. We'll never know with certainty if the counter would and what it would look like if that actually did go through. What I can tell you is that antitrust decisions in a dynamic industry have cascading consequences. And the people who feel those consequences the most are actually always the traveler at the bottom and of the price stack. It's never the top. It's never the executive or the senator. It's the one that's paying the price at the lowest possible common denominator. So what happens next? So JetBlue stock did rise 4 points on Friday on the news that the Spirit bailout might not even happen, and the market's already pricing in routes and gates to grab those slots. Airlines including American, United, Southwest, and others have announced they're capping their fares to help stranded Spirit passengers. And that's a good short-term move, but in the long-term question is whether or not the ultra-low cost market segment, the passengers that Spirit served, can find affordable options in legacy carriers' basic economy tiers. In the broader industry, in a broader industry play, there were 19 of the 20 largest legacy airlines have cut flights in May. Global capacity that was projected to grow 4 to 6% this year could now decline by 3%, according to some reporters. And in Europe's IEA executive director warned that potential jet fuel shortages by end of May if the Strait of Hormuz remains disrupted. So if it stays closed, we're really learning that this is not just a Spirit story. This is a system stress test. This is a system showing where it's fragile. All right, so I'm going to bring in a new segment this week of theme parks. And when you're talking theme parks, there's only two that you're going to start talking about. You have Disney and Universal. And Epic Universal is kind of winning the attendance, but at what cost? Let's talk about the theme parks, because when you look at Universal opened Epic in May 2025, and it's driving some serious traffic. In March, park visits at all of the Universal Orlando properties were up 12% year over year. Those are strong numbers, and it's a great headline. But here's the details that the analysts are paying attention to. Strip out Epic Universe, and the attendance at the other Universal parks have actually dropped 12%. That means that Epic Universe isn't growing the pie, it's cannibalizing it. Guests are choosing Epic over an existing Universal park rather than adding additional days. Disney, meanwhile, posts a steady 3% attendance increase across all of its parks. Smaller numbers, but consistent. And consistency at Disney's scale means something. MoffettNelson's analyst Robert Fishman this week cut his theme park revenue estimates for both Disney and Comcast, citing the Iran war and rising fuel gas prices as a headwind for the drive to destinations. Disney reports are going to be dropping on May 6th. That's going to be a very closely watched call. The strategic question here is whether the Universal's all-in bet on Epic Universe is going to pay off in a multi-year horizon, or whether the consolidation of attendance into one marquee park creates vulnerability if that park has an off-season. Disney's distributed model looks more resilient right now. Sound familiar? We just said the same thing about Spirit Airlines. But There's some really cool news within AI and the technology driven in Disney's parks. Disney's starting to bring together a free roaming AI robot and is coming to a park near you. Here's the real technology story. And it gets really cool, and it kind of got buried in some of the noise because of the other stories that are happening. But the significance of this milestone for applied AI is huge. Disney Imagineering has developed a free roaming Olaf audio animatronic using reinforcement learning. And I want to explain what that actually means because it's more impressive than reinforcement learning is the same AI technique behind some of the most advanced robotics and game playing systems in the world. It's how you train a system to navigate unpredictable real world environments by rewarding successful behavior and penalizing failure. Over millions of simulated iterations, Disney is applying that technology to its physical robot that needs to walk, balance, react to guests, and perform constantly in a chaotic, crowded park environment. They're doing this in a partnership with NVIDIA and Enid Zurich, which tells you there's some serious engineering weight behind the project. And this isn't just a prop, it's genuinely autonomous system operating in a live guest environment. Olaf starts making appearances this year at Hong Kong Disney and Disneyland Park Paris, or Disney Park Paris, and is building upon the BDX droids that are already in Galaxy's Edge. What Disney is building here is not just a better animatronic, it's building a platform for AI-powered guest interactions at scale. If the reinforcement learning approach works reliably in a park environment, which is one of the hardest real-world environments to operate in, you're looking at technology that has implications far beyond the park and into the real world. So let's jump into the travel agency and OTAs. The ACSI travel study for 2026 also scored the OTA category. The results are interesting. TripAdvisor is leading, up 4% to 77, with Booking.com right behind at 77, even though it slipped 1 point. Expedia fell 3 points to 75, Priceline dropped 4 points to 71, and then as complaints started to rise. And Orbitz sits dead last at 68. The pattern here tracks with something I've been watching. The OTAs winning the satisfaction are the ones that are investing in AI-enabled personalized packages and loyalty experiences. The ones losing ground are the ones leaning in or leaning on legacy price comparison models that feel very generic to a traveler who now expects to be known and seen. In episode 2, we talked about how AI is reshaping hotel operations, and we're seeing that same pattern in the OTI customer experience. The interface is becoming intelligent, or it's becoming irrelevant. On the demand side, we touched on the 1/3 of Americans who have already changed their travel plans. But this is critical for the context of the OTA. The third of Americans that have already changed those plans have already seen that the booking volume signals are showing OTAs are already feeling it. But here's the flip side. IATA still forecasts 5.2 billion air passengers in 2026, 4.4% increase from 2025. That's before accounting for the Iranian war's full impact. The trajectory is still upwards, but the margin for error, especially for the lower budget dependent travelers, have narrowed significantly. So let's go back to the Booking.com 2026 predictions that we've talked about. I want to end this sector rundown with something hopeful. Because in the weeks where fuel prices are wrecking budgets and airlines are just shutting down, Booking.com 2026 travel predictions survey, the same 29,000 travelers that we talked about earlier, tell us something important about the human nature. People still want to travel, and they want to travel badly. They just want to get to travel differently. 71% say they'd visit a destination inspired by fantasy settings, romanticities, retreats, castles, landscapes, and that feels otherworldly. And Storyscape Travel and is a real customer segment, not a niche. 79% are open to compatibility trips, traveling specifically to stress test a relationships. Whether it's with a romantic partner, a coworker, a new friend, put two people in a remote cabin with no Wi-Fi and find out real quick on who they are. And 65% say they'd use generative AI to map off-beaten track routes. Now, Gen Z is among 77%, and they're open to a fully AI-routed journey. Here's the strategic read for anyone in the outdoor hospitality, independent travel, or destination management. Travelers are actively seeking the alternative. They want an experience that was designed for them, not an experience designed for everyone. If you can deliver that, you can basically take that entire market and kind of drive where it's heading over the next several years. As we wrap up today's episode, I do want to really focus on one thing. Every story this week pointed to one conclusion. In travel, the difference between winning and losing right now is the strength of your foundation. Royal Caribbean built a unified intelligence layer connecting digital bookings, onboard experience, and post-cruise engagements. And they're reporting record numbers while the broader industry is absorbing fuel shock. Carnival built cloud-native fuel procurement infrastructure across 94 ships, and they have real-time visibility on every dollar when fuel spend matters more than it did even 2 months ago. Disney is deploying AI-powered robots in its parks and using the same reinforcement learning techniques behind the world's most autonomous systems because they understand that the guest experience is the technology platform. And Spirit Airlines, which once changed the economics of American travel for millions of people, didn't have the foundation to withstand a substantial external shock, not because their people were not talented, not because their ideas were wrong, but because the margins for error in a business model were zero. So here's the question I'm leaving you with this week, and what I want to apply to whatever it is you're doing, building whatever sector it is in. What does your business look like when the ground shifts? Not if, when. Because this week's proven again, the ground is always shifting. Iran closed the Strait of Hormuz, fuel prices doubled. An airline that flew 30 million people last year, gone in a weekend. The companies still standing and still growing in this environment are the ones who built resilience, not just efficiently. Unified data, cloud native infrastructure, diversified revenue, strong balance sheets. That's the lesson. That's the takeaway. Diversification and always looking at what happens when the ground shifts. So that's the episode. That's episode 3. It's a wrap. And I genuinely want to thank you for spending parts of your day with me. If this episode added any value to you, please subscribe, hit like, tap that notification bell so you don't miss a week. I do tend to separate some of these segments out into smaller pieces so that if you do know somebody that's in travel or hospitality or aviation that needs to watch a show like this, share it with them. This is how the community grows. And next week I'll be watching for the summer kickoff. The season is here. It's time to look at the numbers. We'll look at how the Iranian war is going to affect the Memorial Day travel. Are bookings moving? Is there going to be any movement on the Boeing China fleet situation? And what's the real deal when we start looking at how all of the Spirit Airlines passengers are really going to be able to be absorbed by either JetBlue or another legacy carrier? If you have thoughts on this week's episode or thoughts in general, please add a comment. Drop them in the comments section. I read just about everything. And with that, I'm Eric Stoltz. This has been Cabins and Clouds. Now go enjoy the trip.